Welcome, my dear students, to SDL Knowledge Hub channel. Today, we will be looking at the first lesson in accounting, Introduction to Accounting. So, if you haven't subscribed our channel, please do subscribe and also leave your comments. So, let's move on to the video.
What is accounting? Before we look at how accounting is done, first we have to know what does accounting do? Accounting is a process of providing information required by the interested parties, or we call them stakeholders of the business, for their decision making. So if we merely provide financial information, then this is called financial accounting. So the main objective of accounting is to provide the necessary information to the interested parties. Apart from the main objective of accounting, there are many other objectives that accounting wants to fulfill. Some of them are to know whether the business has earned a sufficient profit, whether its financial position is in a good standing, and in some organizations to fulfill the legal requirements, and also to organize its financial activities so that it does not have to incur additional losses and difficulties because of omissions and commissions of transactions. So finally, how does accounting provide this information? It's through various kinds of reports. These reports are generally termed as financial statements. Business transactions. Business transaction is an exchange of resources between business and other parties. For example, purchase of goods, sale of goods to other parties, payments of salaries to its employees, getting a loan from the bank, or payment of utility bills, then initially investing capital. All of these are examples of transactions. Then we also have what is called business events. In business events, there is no exchange of resources between the parties, but there's a change in the financial position of the business. Therefore, in a broader sense, we also term events as transactions. If you look at examples for events, we can give damage, trade stocks, then trade receivables or debtors that became bad debt, then depreciation for machinery. Most of the transactions in a business are associated with purchases and sales of goods or providing of services. Now, these transactions could be done in two ways, either paying cash or on credit basis. If the value of the transaction is settled at the point of the transaction, then we term this as a cash transaction. If the settlement is made later on, then it is considered as a credit transaction. Accounting elements. As a result of the transactions, accounting elements occur. They are like the building blocks of accounting. There are five accounting elements: assets, liabilities, equity, income, and expenses. So we will look at each one of them. First, if you look at the assets, assets are generally, we can say, as resources that enable the business to generate economic resources in the future. So then, if you look at what do you mean by economic resources, are resources which will enable the organization in the future to generate cash or income. So using that, we can define assets as: an asset is a resource controlled by the business as a result of past transaction from which future economic benefits are expected to flow to the business. Based on the definition, we can identify three characteristics of assets. One arose as a result of past transaction, is controlled by the business, and future economic benefits will come to the organization. So, based on the definition and the characteristics of an asset, a resource can be recognized as an asset if: one, it's controlled by the business, it arose due to past transaction, then its value or its cost can be measured reliably. Then finally, future economic benefits will flow into the organization. So, if any item or any resource does not generate future economic benefits, then it cannot be termed as an asset. If you look at example of assets: land, buildings, motor vehicles, debtors, because they owe money and we will get money in the future, cash, investments, which are resources in the organization used to in various activities to generate income. Fixed deposit, money deposited with banks for a certain period of time to generate income. Then prepayments, bank account, stocks, machines, etc. Now we look at the next accounting element: liabilities. Liabilities can be said as present payables due to a past transaction. So if you look at the definition of liabilities, present obligation due to past transactions when settling future economic benefits will flow out from the organization. So based on this definition, we can identify three characteristics of a liability. One is it has happened due to a past transaction. When settling its commitments, economic resources will go out of the organization. And finally, it has a current obligation. If you look at examples for liabilities: trade creditors, these are parties to whom the organization owes money. So, by buying things on credit. Then bank loan is money borrowed from the banks which needs to be paid back. Bank overdraft, making payments more than what is there in the current account, so we'll need to settle that to the bank. Then all expenses payable. Earlier we looked at assets and liabilities. These can be further categorized as current and non-current. So if you look at assets, assets can be categorized as current assets and non-current assets. Current assets are assets that are expected to be used, sold, or converted into cash in a short period as 12 months or less in the ordinary course of activities. So that means current assets will not be there or will be converted into cash within 12 months or less than that. Examples for current assets are stocks, trade debtors, fixed deposits less than 1 year, prepayment, and cash itself. The non-current assets are assets that are not categorized as current assets. So everything that is not current assets are non-current assets, such as land, building, machinery, motor vehicle, furniture, equipment. Liabilities, like assets, can be categorized as current liabilities and non-current liabilities. Current liabilities are that should be settled in a short period of time within 12 months, which are also known as short-term liabilities. For example, expenses that needs to be paid, trade creditors, and bank overdraft. Non-current liabilities are all liabilities that are not categorized as current liabilities. So that means which will be settled after 1 year time. So for example, the part of the bank loan to be settled after 1 year's time. Equity. This is another accounting element. Equity is the value of the assets that belong to the owners of the business. For example, equity we can state as examples capital, retained profits, and drawings. Capital is the resources brought in by the owner to the business. This can be done at the start of the business, which is called the initial capital, or when the operations are going on, the owner can bring in more resources, which is called additional capital. Then we also have retained earnings or profits. These are income that is after deducting all expenses that is remaining with the organization from the operations of the business. Then finally, we have drawings, which is withdrawal of resources by the owner of the business. This can be cash or any other asset. So drawings is normally considered as negative equity because it's a reduction in equity. But need to be aware that drawings is not an expense, it's part of equity. Profit. Now profit is not an accounting element, but profit happens due to the interaction of two accounting elements that we will look at later. Now profit is the difference between the two accounting elements, income and expenses. So profit is calculated for a given period of time, and this ultimately is part of equity and belongs to the owners. So we can give profit in an equation. Profit equals income minus expenses. Now in the profit calculation, the first accounting element, we will look at income. Income arises mainly from sales made by the business, and also it could come from other sources too. Now the definition of income is an increase in equity except due to increases from capital introductions by the owners. So that means any increase in equity except capital being inputted by the owners is termed as income. So income helps to increase the profit of the business. If you look at examples for income, sales, commission received, interest income, then rent income, discount rate received. So all these are examples for income. Finally, if you look at the last accounting element is expenses. Now expenses are costs incurred when carrying out business activities to generate the income. Now expenses will reduce the equity or will reduce the profit. The expenses are borne by the owners, so therefore it is a deduction from the equity. If you look at the definition for expenses is a reduction in equity except due to drawings from the owners. So anything that is reducing the equity except for drawings is termed as expenses. So if you look at the examples, cost of goods sold, salaries and wages, interest expenses, rent expenses paid, then discount given, insurance expenses, traveling, water, electricity, and similar utilities.
So hope you got good knowledge about the subject matter. So if you haven't subscribed us, please do subscribe. So until such time, we meet again with a similar video. Goodbye for now.